All right, I'm glad to have your attention once again. The stock market is not giving me a break, and it has a lot to do with the media actually reporting about what's going on today with another perceived crackdown on educational stocks in China. And well, this is all leading into articles around delisting of Chinese stocks, the crackdown on technology stocks in general, and now in specific the educational sector. So I want to give you two examples, or actually three examples. Once again, our friend Jimmy Cramer is at the forefront of this time. He's telling us to sell all Chinese stocks. Other days he's telling us to buy them or pick up as much or as many shares of Didi Chuxing as you can. So, well, this is basically in order to give you some, just some examples of maybe sharpening your views around how the media is reporting about stuff. And then, well, I give you my thoughts and my opinion around it from somebody who has lived in China, worked in China, invested in Chinese companies, speaking Chinese fluently, and obviously being a China stocks bull. So take this with a grain of salt. I'm obviously a bull, and I see it kind of maybe different from what is out there in the media, but there is some fair reporting about the risks associated with investing in Chinese stocks. So I want to kind of give you both sides, if that's possible, and my kind of commentary of how to think around it, and then it's up to you whether or not you still want to be invested, or you see this as an opportunity or as a threat. So as always, this is not financial advice, this is not stock trading advice at all. Basically giving you just my opinion here. So let's dive into a news that I got from various sources this morning about NIO stock falls after shareholders file to sell off their stakes. And that's coming from Market Watch, and basically was announcing that, users been asking me from my Patreon community, why is NIO making a new share offering? Where, well, even if you read the news, it's basically stating that two funds are selling their stake in NIO, and there should be an S1 filing with the SEC, basically stating that NIO is making a new offering. But basically I couldn't find such filing, and turns out after digging a little bit deeper that this was actually false reporting by Market Watch here, because this was actually about a filing of Nikola, the American fraud stock Nikola that has actually run away with quite a bit of investors' money from the US. And basically this news was aligned with NIO stock in this morning, but wasn't about NIO at all. So it seems like they later on corrected it after I've been calling them out on Twitter. But this is also a lesson of that you need to think for yourself, really look up the S1 filings, for instance, have a look whether or not these people are actually invested in NIO or not. And then obviously also, this was just 0.4% of the holdings of the share outstanding, so it wouldn't have moved the stock possibly anyway. So, this is kind of the relations that you need to see from time to time. So I don't want to accuse Market Watch of false reporting on purpose there. That would go a little bit too far. I guess maybe that was just a mistake. But it's having a little bit of a flavor if you look at some previous reports yesterday coming out, and I just read it today actually, about this is your final warning, Chinese stocks listed in the US are dangerous to hold. So it seems in general, there is a little bit of, let's say the media enjoys it, all of those clicks and so on, and there's, I know that this fear sells. Honestly, some of the videos I make that are more on negative news, they also get the most clicks. So I know the media bias and the media incentives behind that. But anyways, this article is actually unfair in some regards, in my opinion, and actually quite fair also in other regards. So let's maybe go through it and give you an example of how I'm personally reading. All right, so this article goes actually on, we have been warning about Chinese stocks since all of the time, and basically the notion is that you should sell Chinese stocks as soon as possible because there is it's just too much risk in it. But let's not be too negative about it, because actually there are, I think from a journalist perspective, some quite good takes in there as well. So basically here I highlighted already that regarding this delisting of Chinese stocks, they put this important bracket here, which is that it remains a big if that is going to happen. So you can see by that this is actually quite balanced. So they also show the other side, and that they are not saying that this is definitely going to happen. So they go on and talk about this new legislation about this whole Holding Foreign Companies Accountable Act and so on. And I'm gonna into that later, but an interesting paragraph here is quoting a Harvard University guy, professor of law, yes, which says basically he sees the opportunity for China to drive down the price of these companies before having rich Chinese investors take them private at a lower price. He goes on and says the people who control the company plan to take them private, and they may release bad news and withhold good news for the stock so that it goes down, and then they can buy it back at a very low price. So I don't know what is your personal experience with investing in Chinese stocks, but for me it's actually that most of the Chinese companies are putting out lots of positive news without anything happening to those stocks in particular. So one example would be that I have in my mind is Baidu. Baidu is very active in communicating lots of positive news. Baidu stock has long not doing anything, similar to, for instance, Xunlei. I talked about this company in the morning, and Xunlei is also quite active in usually disseminating good news if they have it, and some achievements. Also Sap Health is very active communicating good stuff. So it doesn't make the impression to me at all that Chinese companies try to beat down the stocks in order to buy back their shares. And then if this professor is saying that the Chinese companies are often doing this, then I would like to see more than just the Qihoo example here, because he's basically making a generalization here and kind of makes it sound that this is in the intent of these companies and of many of those companies actually. And in my point of view, this is just not reflected in what I'm seeing in the real world. Another argument here is that he says, for instance, that Qihoo went private at a 9.3 billion valuation, but then when it got relisted in Shanghai, the shares have been soaring to 56 billion in valuation. And he takes that as an example of the bad intent by this company to kind of buy the shares low and then make a bargain and relist it elsewhere. But I would basically say that this is an argument that on other exchanges these companies are actually better understood, and I actually see that most US listed Chinese companies are actually being undervalued by those foreign investors, and that this is actually a problem. And that's possibly also part of the reason why many Chinese companies are now doing secondary listings in, for instance, Hong Kong, or even want to list at the mainland Chinese market, because that's where lots of the Chinese investors are actually able to buy the shares and possibly have a better understanding of the companies. But to be fair, they also say that this happens to American companies too, and that it's unlikely to happen for big companies like, for instance, Alibaba. Then the article here lists another important fact in my views, which is that the Chinese US listed companies have a combined market capitalization of 2.1 trillion. So this also tells you how important these Chinese equities are, and this is also paying more into the following arguments, which are that the negotiations between the two countries should actually happen. And then this China expert is being quoted as that my gut sense is that China will try to reach some accommodation with the US government regarding this Holding Foreign Accountable Act. And that's also my views. I think those two sides will negotiate and try to find a common agreement, because for once, for the Chinese companies, it will be important to stay listed in the US, to have access to foreign capital, and also for the Wall Street and for the US in general, also as a place with the importance of the financial markets, it should be important that these 2.1 trillion in assets will actually stay there. In addition to that, there is also the Wall Street IPO fees that can be earned. And this is also, once again, coming back to this argument whether or not China wants to, just make IPOs and then take the companies private later on. This is actually not reflecting the truth of how these deal flows are actually going, because usually this happens at the venture capital stage in China, where already Western investors are also part of the funding of those startups and also the investment banks coming in, and then they actually may pressure those companies to do an IPO, because that's when they can finally cash out. And that's also part of the big reason what's happening with Didi. Didi went ahead and did their IPO despite the warnings by the Chinese regulators, but it seems like the shareholders of Didi, the early investors, they wanted to cash out and go IPO in order that the public markets will actually invest in this company. So it's not really the intent of China in order to make this, it's rather the investors behind that, and that could be actually Western investors. Then the article goes on and tries to uncover what are the reasons actually behind that the Chinese government is cracking down. And I think the explanations towards this are falling short of the reality. So I see this narrative often that China, yes, is a totalitarian communist regime, and going on here, they want to have the monopoly over the data of the people. And yeah, information is power, and Beijing doesn't want other people to have this kind of data. So I think this is really going too short of an explanation, whereas yes, the Chinese government is certainly surveilling their people more than, for instance, what we are used to in the West, although I would make the argument that the West is catching up quickly with that. But I would say the true intentions here of the government is once again social stability, and also their big picture of this harmonious society. That's a big picture there of the Communist Party, which they want to see, and that's why they are once again cracking down in areas that are sensitive to having stability in the country. And that is the financial side. That is also now on the education side, where they want to make sure that there is an equal access to education, and also that these companies are not, for instance, using marketing ways of scaling into a young population, exploiting it, getting lots of money out of them for teaching, and also taking over some of the government responsibilities there in order of teaching parts of the curriculum. So that's what is really behind that in my point of view. But I'm obviously also not happy the way that this crackdown is now certainly happening, and I also think it's not wise by the government to crack down on the online education in this regard, because I think they should rather support these companies in providing better solutions, and also to making it accessible to many different peoples, regardless from where they're coming from. But I'm also not invested in any of these educational stocks, so that's why possibly I cannot give you the most deep insight on these stocks in particular. But the bigger picture here is that I think what is quoted or given as an argument here by lots of the Western media as a kind of an explanation to that is oftentimes falling too short of the real reasons behind that. But once again, this article has also some really good hidden gems here. So for instance, they've been talking to someone who was the former chief of accountant at the SEC, and they're summing up once again very nicely that this Holding Foreign Companies Accountable Act will require the SEC to prohibit those securities from US markets after 3 years of consecutive non-compliance if the PCAOB is unable to audit those companies. And that, speaking to those insiders here, and saying that it's unlikely that any delistings will happen before 2025. So that's actually also some interesting insight, which I think is really good reporting there. By 2025, NIO may actually be trading at triple digits, who knows. But jokes aside, also this article at this point is fairly based, saying that there is too much to lose on both of the sides. Now they also point out one argument here, which I think is interesting, that the Chinese government will possibly stop letting the PCAOB inspect those companies in order to actually lure those companies back to China once the capital markets are sufficiently developed. And this is actually also an argument which I pointed out also to my patrons in the recent days. which I saw put forward by the Chinese administration because some unusual stuff has been happening. First, companies listed at Hong Kong stock exchanges are exempt from some of the rules that are now restricting foreign listed Chinese entities. For instance, user data gathered from more than 1 million users is now subject to that the regulators and authorities are actually having a look at what kind of data it is before being allowed to actually list as an IPO. So in Hong Kong, these rules do not apply. So that makes it easier for them to actually go to Hong Kong instead to the US if they don't want this sort of inspection. And then another interesting part is that there is a pilot project running or announced that actually foreigners will be allowed to invest in A-shares. So these are the mainland listed Chinese equities for which right now we cannot invest, or only through some funds or through some really complicated vehicles. But so for us it would be the equivalent of actually buying stocks at the New York Stock Exchange, to be actually able to buy some companies, Chinese companies, actual mainland companies that are not in this VIE structure and listed in China. So that would be a first. And my interpretation of things is that, yes, of course, China at some point in time may want investors to start coming into China and do that once maybe the structures are there. And for now, I think there are possibly just an argument in this whole US-China trade negotiations, which have now started again with the Biden administration having taken over. And now, obviously, both sides are taking their cards and jokers and arguments on negotiating this new deal. And of course, for the US, a big card in this deck is we're gonna delist all of your Chinese stocks if you don't, let's say, buy corn from us in the next couple of years. And then the Chinese side is now going like, well, we allow foreign investors to invest in Chinese companies directly. We don't care anymore if the Chinese companies are listed in the US. So kind of neutralizing this argument that the US counterparts are possibly having. And what I expect is that at some point, both of those sides will come to terms. And of course, the US wants to have this Chinese stocks once again. The US has a big lobby from Wall Street who is interested in that. And of course, the Chinese also don't want to let them delist it. And of course, at the same time, they also want to attract some capital inflows to maybe some Chinese marketplaces. But on the other hand, they also know that they are not ripe yet and there is not enough trust and there wouldn't be enough volume to that. And so this article is actually fairly balanced in a sense of that it's outlining that there is possibly the opportunity there that both sides will come to terms and so on. On the other hand, it's warning investors of doing the right thing here and doing some risk management there. And but on the other hand, as I mentioned here, most of those explanations here, I think, are not sufficient. And of course, the headlines are big. They are around fear, and that has to do with the media needs those clicks and so on. And so that might scare some of the uneducated investors. And on the other hand, I don't want to talk down that there are issues with some of these equities. So for instance, the name here, Luckin Coffee, which has been a fraud, obviously. But on the other hand, maybe also they would need to mention that Luckin Coffee trading over the counter right now has also recovered after cleaning up some of the books, and also that there are American names that are having issues. There are German names like Wirecard which are having issues. So I think the general thing here is rather that investing in stocks is risky, and possibly it's about finding the right ones, and sometimes this can be easy, sometimes this can be bad. And for instance, for Chinese stocks, it's definitely not easy because there's lots of misinformation and not a good understanding, particularly I think from US investors' side. And also it's also of course some sentiment and some emotions around it because they feel kind of threatened by China as a new superpower. So there's lots of saber rattling going on in the background, which I think is possibly quite unnecessary there, because I actually don't see China as an aggressor in many cases there, and I think the US should be proud of the innovation which they're having. But on the other hand, I think China is not well regarded for all of the technology and the innovation which they have brought forward in the recent days. And so let me add a little bit of my personal perspective on that, which is that the conversations that I'm having with people that have been living in China and maybe also speak the language, and particularly people also from Europe, I would say, they have much less this stereotypical thinking. They have a much more, I would say, rational thinking about all of this, and they could be actually the true beneficiaries of that, because I think in the long run, I still think, looking at some of these valuations, and this article is also pointing out that retail investors are actually very excited about Chinese stocks, and therefore many of these names have actually high valuations. Tell me one Chinese stock that has a super high valuation. If I look at Baidu, if I look at Alibaba, these companies are trading at big discounts regarding, in contrast to their Western counterparts. And I would argue that, if there wouldn't be so much fear around it, and if there would be a better understanding of China, these stocks would possibly trade at a much higher level than they are doing right now. But anyways, I cannot tell you what you should do in this situation. I can only tell you what I'm personally doing, and I put my money where my mouth is. But of course, I could be wrong on that. I've been making wrong calls in the past as well. And so, I just think I'm very bullish on this China opportunity in the long run. I'm a long-term investor. Usually short-term trades didn't work out so much for me, although I see that there are issues, of course, and there are opportunities also to sell now and buy back later at lower valuations if possible. But in general, these are my thoughts around how to deal with such kind of news. Be a little bit of a critical investor. Please be critical against myself, because I'm also biased here, but I'm maybe one of the few voices out there who are actually bullish on this China opportunity. So balance your views. Take both sides, and then you need to pull the trigger yourself. Anyways, thank you guys for watching, and enjoy the weekend.